Hello, good morning and welcome to Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Ormaz Pataki as well. Ormaz, good day coming in for the markets. We are seeming like bulls and bears here, but surely they've picked your side today. I'm happy about that. No complaining. 25,200, we're managing to hold on to that. So it's a good day coming in. And broader and also doing well like yesterday.
Oh yes, new highs for the year. And the index would only be hopeful that another 1,000 points away from 26,277. Hopefully that should arrive soon as well, is what the bulls would be hoping for. And it is the index heavyweights that are taking the Nifty higher in that 250-point gain, be it HDFC Bank, be it ICICI Bank. It's a 550-point advance on the Nifty Bank as well. And that is also heading back towards its previous earlier highs of around 57,000, and there you can see another almost 600 points higher now on the Nifty Bank. And the broader markets, they did well yesterday after that recovery from the lows, and they are continuing to do well in today's session as well. Another 550 added on the mid cap index, and the small cap index too painting a similar picture, if not better, doing fairly well for themselves. A 200-point gain on the small cap index as well. Here are some of the movers in the broader markets though, and there are exponential gains today. Enviro Infra Engineers, there's a 300 crore odd order win that it had, and the stock is up 14% in today's session. Is Enviro Infra, it's a recent listing. GM Financial is up 10% in today's session as well. We'll get to some of the other gainers in just a bit, but Vinny, you know, the broader markets, the gainers are far outnumbering the losers as of now.
Absolutely, and most of the sectors are today trading in the green except for Nifty Media. But let's shift focus and now talk about commodities, because that's the space everyone focuses on given the volatility and geopolitical tensions that we see and the change that keeps coming every day. Manisha is keeping us updated with all of that. Manisha, good morning. And crude, as fast as it went up overnight, we did see that fall coming in as well.
Oh, well, absolutely. You know, 5 to 7% of a move every day clearly seems to be becoming a norm. And I don't think that's going to change anytime soon for the rest of 2025 as well, given the fact that you have so much to watch out for in the coming year as well. But at this point in time, after that 7% decline in the overnight markets, we're looking at Asia opening 4% down as well. At this point in time, is down by nearly 2% or thereabout. If you look at the last 1 month, well, that criteria or maths also has changed. We're up just about at 9% right now. And yesterday we were talking about on how we've turned positive for 2025. Well, not anymore. After that overnight move of decline very sharply in case of crude, we are down by 7% for the crude oil prices for 2025 at this point in time. Well, just to reiterate on what we've been talking and the reasons that you've seen the crude oil prices come off, one very important point is that the reason that we are back at the levels that we saw before Iran-Israel war began is the US president's statement that came in suggesting that there is a ceasefire now between Israel and Iran. And in the last few hours, we have seen those kind of statements coming from Israel and from Iran as well, cementing what the US president said, and is the reason we're looking at that easing coming in sense of prices. Also, apart from that, while there was Iran's retaliatory strike on US base in Qatar, we do understand that the damage was not too much and there were absolutely no casualties. So that also led to prices coming off. Apart from that, it also has to do with the oil market's worst case scenario of a closure of Strait of Hormuz. Well, that clearly has been avoided, at least for now. So that premium is also off. And then very interestingly, the US president yesterday tweeted saying that this is for attention for everyone. Keep oil prices down. He said, I'm watching. This is what he wrote on Truth Social. He also says that you're playing right into the hands of enemies. Don't do that. So these kind of statements as well coming in from the US president is something that was the talk of the town on Twitter yesterday. Well, if you look at various brokerages, we've already spoken about on what all of them have said in a worst case scenario. If Strait of Hormuz does get closed, on where the crude prices could go, then perhaps triple digit as well. But now, since we have seen some de-escalation, Mizuho Group sees that $85 was a possibility if it would have escalated, but de-escalation can bring the prices down to $65 a barrel. That's exactly where we are trading right now. Not just them, trading.com also says that they're looking at a range between 65 to 85 for the rest of 2025. Bank of America has talked about 75 as an average for this year, and they feel that 60 to 80 is a range that can hold for until 2030 as well. And then you have Citi suggesting that if there is de-escalation and a ceasefire and US and Iran also agree on a nuclear trade, then you could be looking at prices coming all the way down to $55. Well, that's about geopolitics, but there's just so much to watch out for going forward from here. You have Fed rate cut plan in June. That's what various Fed officials have spoken about in last 2 or 3 sessions. July 9th is a tariff deadline. That is something that the markets will watch out for. And then apart from that, it also is going to be about hordes of data coming in from US, passage of US tax bill, that is back on radar, and Jerome Powell's testimony tonight. Well, that's going to be the most important thing to watch out for today.
And indeed, one day higher, the other day lower, and Manisha is on top of oil and all the other commodity updates. Thank you so much for that. And since Manisha mentioned Donald Trump, he just put out a couple of posts on Truth Social. He's still active though at this hour of the night in the US, that the ceasefire is now active. Please do not violate it. That was one. And since Manisha also mentioned about Jerome Powell's testimony later in the night, he's just put out a post on Truth Social calling him too late and about the fact that he will be heading to the Congress today to testify as to why the Fed has not lowered interest rates just yet. But since we were on the subject of oil, we'll talk to you about the big gainers and losers from this fall that we have seen in crude oil prices, from the highs of $81 a barrel yesterday, now sub 70. Sudarshan is here with all that analysis. Sudarshan.
So we'll start with the companies which might be impacted negatively, and those companies are upstream companies, upstream oil companies they are called, and those are ONGC and Oil India. If there is a significant fall in the crude, say for example there is $1 fall, so basically $1 fall impacts annual revenue of these companies in the range of rupees 300 to 400 crore. But in contrary, fall in the crude is positive for downstream companies like OMCs, and those are IOC, BPCL and HPCL. If there is a $1 fall in the crude, it impacts these companies' EBITDA positively in the range of rupees 200 and 300 crore. Now, apart from oil companies, fall in crude also impacts positively to paint companies, because up to 50% of their input costs are linked to crude, and if there is a major fall in the crude, it basically helps their revenue and EBITDA. And last part is it helps aviation companies, because for aviation companies, ATF is the major input cost. ATF is known as aviation turbine fuel, so it's positive for Indigo, and that's the reason you are seeing a major move in these companies which are impacted positively, and companies like ONGC and Oil India are down in the trade.
Absolutely, Sudarshan. Thank you so much for that. Keeping an eye out on all these companies which get affected by crude because they use crude or crude derivatives in their raw material. Next stock that we are putting a spotlight on right now is KPIT Tech. They came out with their mid-quarter update. So it's a quarterly update for the company. Week update that came in on the business front for the company. They've said that overall, when you're looking at it, the business environment, they're still cautious about it. Given that there's so much going on in terms of geopolitical tensions, tariffs, there's no clarity as such on that front as well. The pipeline in terms of deals, that is continuing to be strong, but the conversion is much slower than expected. The demand trends in Europe, yes, that is good. But in US and Asia, that's a bit uncertain right now. Other than that, ramp-ups in terms of wins also, they are progressing, but at a slower pace. So most of the things are happening for them, but at a slower pace. So that means that obviously they're going to see some bit of an impact coming in Q1. There's not going to be any one-time gain this time that was there in Q4 FY25 and Q1 FY26. So impact on profitability. Overall, in terms of deficit also that they're going to expecting to see in other income is what the company is highlighting due to the changes in terms of overall the forex rates. Now, on the back of this, Kotak Institutional Equity has come out with a note, sell rating, target price 1,000 rupees. They've cut the FY25 to FY26 to 28 earnings by 3 to 4%. Even JP Morgan is maintaining their overweight rating, target price of 1,500 rupees per share. But now they believe that Q1 FY26, that could be a quarter of decline for KPIT Tech. And obviously, bounce back is only expected in Q2 FY26. So they have also cut the organic growth by 4% in FY26. And CAGR growth also is cut by around 2%. For FY26 to FY28, they were expecting 16.5% previously. Now it's at 14.5% with us.
On a day when the mid-cap index is up 500 points, KPIT Tech is down 5%. So an underperformer, bucking the trend in today's session, has been an underperformer over the last 12 months as well. The other sector that is not doing well other than KPIT Tech, though, is defense. Of course, profit booking coming in after all the moves that we've seen. Garden Reach is now down 6%. BEML is down 6%. Mishra Dhatu is down 5.5% as well. So defense as a pack not doing well. Take a short break. On the other side, the management of Ellenbar Industrial Gases joins in on the other side as their IPO opens for subscription today. They get to you a conversation with them on the other side. Stay tuned. Welcome back. And as the markets have started to recover, the primary market activity has started to buzz as well. As many as 3 IPOs have opened for subscription today. One of them is Ellenbar Industrial Gases that has also opened for subscription today. It closed on the 26th. The issue size is 850 crores, price band of 380 to 400 rupees. The company being a manufacturer and supplier of industrial, medical and specialty gases. Now to discuss more on the company and the prospects, Varun Agrawal, who is the Joint Managing Director, along with Padam Kumar Agrawal, who is the Chairman and Managing Director of the company, are joining us. Gentlemen, good morning. Thank you for joining in. Varun, first question to you. Firstly, congratulations on your heading towards the Dalal Street. We'll be seeing you soon on as a public company as well. You know, first question, of course, being on the revenue mix, if you could talk about it. You are in various segments of gases, be it industrials, medicals. If you could talk to us about the revenue mix, and which is the one segment that you would want to play more or lay more emphasis on going forward?
So thank you so much for having us on the show. The revenue mix is primarily driven by our core industrial gases business. That's about 95% of the revenue, and about 5% comes from project engineering services. Within the 95% of industrial gases business, most of the revenue comes from the 3 core gases, which are oxygen, nitrogen, and argon. Healthcare accounts for about 10% of our overall revenue, and healthcare typically includes oxygen. Going forward, we would like this revenue mix to be driven by the core gases business with a greater emphasis on argon revenue, since that tends to have a higher EBITDA margin.
Okay, that's interesting there. Mr. Padam, good morning. This is Vinny joining in the conversation as well. Firstly, also, where are we currently seeing the end-use demand increasing, or where do you think the drive is coming in as of now in today's scenario?
The traditional businesses, the traditional consumers like steel and pharma would continue to have higher demands. And at the same time, we see new demands coming in from the new age industries like solar and electronics, semiconductors, and likewise.
Do you see, Mr. Agrawal, do you see that the new businesses that you're talking about, especially the solar business, considering the emphasis on renewable energy that the country has been putting on, would this become a significant part of your business, say, over the next 3 to 5 years? Or would you consider being on the traditional side of the business itself?
We would like to be in both segments. The traditional part is still very strong, and it will continue to remain strong given the growth rate of the country. And steel and pharma being very basic and primary industries, the new applications which are coming in would call for requirement of high value gases, and that is where we would expect improved margins.
Okay. That's why you're expecting improved margins going forward. Varun, let's just talk a bit more in terms of overall the capacity utilization that's currently that you'll have at your different plants and your key plants. And how much of a headroom do you think over there is there for growth in terms for the company?
So our historic capacity, say about a year ago was about 600 tons per day, which is currently fully utilized. In the last financial year, we've set up 2 new plants, which has now taken our capacity from 600 tons per day to about 1370, so 1370 tons per day. So that's more than doubling of our capacity. And going forward, we have plans to set up 3 more plants. And we would expect our capacity to be about 21 to 2200 tons per day, say about a year from now. So there is a lot of headroom in terms of the new capacities coming in, and we are ramping up the capacity utilization as we speak, which will lead to strong growth both in terms of our revenue, bottom line, as well as margins.
Varun, any other differentiator or a standout aspect for your company would be that how do you differentiate when it comes to competition? There are other companies who are into similar businesses as you are, be it Linde or be it Inox Air Products. What is one aspect that will differentiate you from competition and make you stand out when it comes to being in similar business lines?
So look, our key differentiator is that we are a 100% Desi company. So we are competing with multinationals. I think most of the industries that you see, they have a combination of Indian companies as well as multinational companies. We have our advantages in terms of, having strong customer connect, being very agile, being quick to act to situations, able to build up our capacities a lot faster. And of course, our competitors are sort of global giant companies. So, they have their own advantages. I think there's a place in the market for both of us.
So Padam, I just want to understand one thing right now. When I'm looking at the financials, while FY22, the profits were somewhere around at 672 crores, then it went to 281 in FY23, and now in FY24, the year end was at around 453 crores. Now, given that obviously there's going to be debt repayment that is going to be happening with this IPO as well, and you all are setting up another plant as well, right? Air separation unit, which you all are setting up for around 100 crores. I want to understand the outlook for profitability, and in the past years, what was the reason for this, increase and then decrease in terms of profitability?
The spike you see was mainly due to the effect of COVID. There was an additional demand for medical gases, and the values were also relatively high. So, and subsequently when COVID was over, so there was a correction, sort of. And further, last year, we have added fresh capacities. And as we will also plug in new capacities this year, so the graph will continue to remain upward. There was only a correction in FY23, and that was largely because of the correction coming in from the diminishing effect of normalized situation after COVID.
Clubbing two questions into one due to paucity of time, gentlemen. First one being that how much is the current capacity utilization across units? What is the scope for growth here? And part two of my question is the utilization of your proceeds. A lot of it is going towards retirement of debt, and you're also using some of those towards adding new capacities. Is that the only capacity addition program that is on the anvil currently, or there are more in the pipeline over the course of the year?
So, as I mentioned, our historic capacity is fully utilized. We've recently set up 2 plants. Those plants are currently ramping up in terms of capacity utilization very rapidly. We will need more capacity, and some of the proceeds, part of the fresh issue is being used to set up 1 new capacity. Apart from that, we have 2 more capacities which we are planning to add. So as I said, the capacity ramp up will be like 600 tons, going up to 1370 tons, and then going up further to about 2,200 tons per day.
Okay, gentlemen, thank you so much for joining with us on the show today, and good luck with your IPO. Hope to see you all more often now on the channel as well after you all make your debut on the T Street. So thank you so much for that. But on that note, we're going to actually slip into a very short break. After the break, we'll return and we will discuss market technicals with Mitesh Thakkar and his top bets. Welcome back to Trading Hour on CNBC-TV18, and on Nifty today obviously managing to hold on to very strong gains in today's trading session. But let's understand the market technicals with Mitesh Thakkar. As of now, also Nifty at the day's highest point, almost around that mark, 25,260. Mitesh, good morning and a good day surely panning out for the Indian markets and global markets as well. But what are you looking at in terms of levels for the Nifty and the Bank Nifty now, and in terms of your top bets that you're looking at as well?
So to begin with, good morning. To begin with, I think, I was looking at 25 to 20 to 50 as the supply pivot. I think that's been cleared. Now, getting past that means that the index has got a fair chance of heading towards 25, 450 to 25, 500, and then we'll take it from there. The trades on the positive side, if somebody wants to buy Nifty now, while this may not be the best entry point, but yet I think it offers a good trade if you keep a stop below 25, 185. So you have about 85 points of risk and 25, 450, 500 is your target. That's on the index. And on the stock side, I have buy on Chambal Fertilizers, the stock just below level of 556 for targets of 580. And the other one which I like is Colgate Palmolive, which I would buying the stock below levels of 2416 to 24.
Mitesh, thank you for sparing time joining us today. Views on the index and on specific stocks as well. Interestingly, UBS had also come out with a note on Colgate a couple of days ago with a buy recommendation and a 3,000 rupee price target as well. Take a short break. On the other side, more on the markets with Venkatesh Balasubramaniam from JM Financial Institutional Securities. On the other side, stay tuned. Welcome back, and currently at the highest point of the day now, 300 points higher on the Nifty, 1,000, almost 1,000 now on the Sensex. And Venkatesh Balasubramaniam from JM Financial Institutional Securities is joining in to take this conversation forward. Venkatesh, good morning. Thank you for joining in. Just reading your note where you mentioned that the EPS downgrade cycle is still not over, and we have almost recovered around about 3,000 odd points from the lows that we had made during the tariff drama. What do you expect from the first quarter of this financial year? We'll just start reporting numbers in a few days from now. Is this going to be a quarter similar to what the third and fourth quarter have been of the previous financial year, or do we see some green shoots of earnings recovery start to show up now, considering that we'll be having a low base of last year?
Okay. See, our analysis suggests that the earnings, decline cycle has not kind of ended. Even in the month of May, we saw something like around 1.5% to 2% kind of EPS cuts on the Nifty by consensus. As we start first quarter, I wouldn't be very, very optimistic because you will definitely not see great growth from the banks. Banks form a very big chunk of the index. So with the interest rate cuts, you could definitely see a NIM compression in the current quarter. Not that it is not part of consensus expectations. I think most people have already factored that in. We are expecting weaker numbers from even the auto sector. So I don't think it is too early to look for green shoots at this point. This time is our view. And anyway, for the current year, I think consensus expectation and even the JM Financial expectation is that EPS growth will be in the low double digit kind of level, maybe 10% to 12% growth for the full year of FY26. So still early times to look for green shoots. We personally believe the second half will be better for EPS growth than the first half.
Okay. H2 for EPS growth will be better than the first half, and you're saying autos is not something exciting, as well as banks. You're not expecting them to do well in Q1, obviously given so much has happened from their front. Venkatesh, good morning. This is Vinny joining in the conversation as well. But then where do we find value, right? At such a point of time, what should you be looking at in terms from the market point of view? Should it be more large cap? Should it be more mid and small cap? What are you all looking out for?
Okay. Now, there was a brief period, maybe 1.5 months back, where there was a definite trade available, which was large caps were preferable to small caps and mid caps. But we personally believe that opportunity is long gone now. after the rally in the large caps. If you look at headline valuations, you will perhaps feel large caps are cheaper. Large caps are trading at maybe 22 times FY26. Mid caps are trading almost like 29 times, and small caps are at 25 times. But interestingly, the EPS growth profile, if you look at consensus numbers, are very, very different. So for large cap, expectation is around maybe 10% growth over the next 3 years. For mid caps, the expectation is almost like 20% plus growth over the next 3 years. For small caps, it's 15%. So if you adjust for growth and you look at something like a PEG multiple, you will realize that actually mid caps are much more cheaper than large caps. So this prefer large cap trade is largely over. Incrementally, it is about, you should not bother about the market capitalization of the stock. If there is growth visibility, you should go for that stock and not really bother about what is the market capitalization per se. Now, interestingly, we said for the first quarter, banks' numbers might not be that great, but we still would suggest investors that they should be overweight banks because the weaker numbers are largely in consensus expectations. But if you broadly look at across the board, all the sectors in this in India, if you look at the Nifty per se, banks is one sector where valuations are very, very reasonable. Private sector banks are trading at in line with the historical mean. Public sector banks are trading one standard deviation below. Most of the other sectors in India are trading at one standard deviation above mean. So valuations do not make sense. So that is why we have in our model portfolio, we're running almost like 120 bips overweight on banks. Incidentally, we have an overweight even on insurance because insurance valuations have also started looking very reasonable. And even for AMCs, we are running a small overweight. NBFCs and AMCs, we are running a small overweight.
Venkatesh, there has been plenty of chatter regarding the oil prices and all the developments that have happened. Crude almost down now 15% from the peak that it made yesterday. Now, where do your preferences lie within this oil and gas basket? Or are you even preferring this basket to begin with, whether it be the upstream explorers, the ONGCs and the Oil Indias, or the downstream refiners, the oil marketing companies, or even the city gas distribution players or the IGLs and the MGLs?
So we have a complete avoid on oil and gas. But surprisingly, we have an overweight on oil and gas because we have an overweight on Reliance Industries. And we are playing Reliance Industries for the telecom business, not for the oil and gas business. Yes, even in Reliance, we believe petchem margins have kind of bottomed out. But overall, we are not too constructive on oil and gas as a sector. We like Reliance Industries for the telecom business. And for that, because we believe over the next 12 to 18 months, there will be rate hikes in telecom. And beyond that, we also believe that if we see a Jio IPO over the next 12 to 18 months, the sector could re-rate. So we like telecom as a sector. We like Reliance hence. And as a consequence, we can't help it, but we have gone overweight on oil and gas because of the telecom business of Reliance. And we are also positive on Bharti. So we are overweight on the telecom sector as well.
Okay, so telecom is also something that you like. You're more overweight on Reliance's telecom side of the business, but obviously it comes as a parcel. And Bharti Airtel is also what you've mentioned. But Venkatesh, thank you so much for joining in with us this morning on CNBC TV18 and giving us your views in terms of individual stocks, sectors, and what are you watching out for on the fundamental front. So that was Venkatesh joining in with us from JM Financials on his views on the market. But on that note, we're actually going to slip into a very short break. And after the break, we'll be joined by the management of Visual Projects, joining us to discuss their latest order win and their business outlook going forward.
Welcome back. Now, Visual Projects recently secured an ultra mega power transmission order from Power Grid. Now, this is an EPC contract for power transmission lines and substation bay extension works. To discuss this and more, we are now being joined by Mr. Rajesh Ganesh, who is the Managing Director and CEO of the company. Mr. Ganesh, good morning. Thank you so much for joining in. If you could tell us more about this Power Grid order and what is the timeline by which you are supposed to execute it? What are the kind of margins that you are accruing from this order? More details on this, please.
Yeah, well, good morning to both of you, and thank you very much for having me here. Well, this is one of the two ultra mega orders that we have won for this quarter. This one is a roughly about 137 kilometer, 400 kV double circuit line that goes between Mahan and Rewa in Madhya Pradesh. So it's got two packages. One is the transmission line in itself, and the other one is a bay extension work that we are going to be doing at the Rewa substation. So this is one. The second order that that I want to talk about is something that we announced earlier in the quarter, which is sort of a 127 kilometer line, but much heavier, 765 kV line that we won again from Power Grid. But this one goes between Kurnool 4 to Kurnool 3, which is part of a larger sort of TBCB package. And we're doing two of them. But this one also involves design and engineering alongside with the routine activities of supply erection and commissioning. So both of these we are going to be, obviously the client is going to be Power Grid for both of these.
Absolutely. Rajesh, good morning. This is Vinny also in the joining in the conversation. You spoke about two interesting projects coming in during this quarter as well. FY25 is what I'm looking at right now. I have the number coming in for the order book. That's today around 2,984 crore. Right. How do you see this moving up overall for FY26 or the first half of the year as well? If you could talk to us about that. And in terms of margins, how will they start shaping up? These two orders, what does it mean in terms for your margins of the company? Because year-on-year basis, when I'm looking at it for Q4 FY25, good improvement in terms of margins. So I just want to understand in FY26, what are we expecting?
Okay, certainly. I'll take them one after another. Yeah. We'll talk about, maybe we'll sort of talk about the order book first, and then we'll go to the margins thereon. So, well, if we look at, as you've got on your screen, if you look at the end of the financial year, sort of last financial year, we were a shade bit north of 2,900 crores, bit less than 3,000 crores. Now, with these two orders coming in this quarter and a few other small orders coming in, we'd be hovering sort of close to or in and around 4,000 crores in terms of order book. Now, in terms of margins, there's a concerted effort that's going on to improve the margins. If you, as you sort of already know, we are a relative sort of newcomer here. Even though we have this Bajaj sort of brand over us, we still fairly new as compared to other well-entrenched players. So we have a bit of work to do in terms of, reducing our sort of COGS margin, COGS expenditure rather, and also our interest cost. But those are some of the things that we are looking to sort of do to increase our margins. It definitely would be better than what you've seen in the past.
Better by how much? What is it that we're expecting? 100 basis point? What are we watching out for in FY26 then?
Well, our focus, Vinny, largely has been on quality of the unexecuted order book, really, not so much on the quantity of it. For me, the way I define quality is really executability and profitability. Those are the two ways I'm looking at. So both of these are really needed in order for us to pick projects. So we're going to be fairly selective in the way we pick our orders. The focus is not to drive a lot of top line. It's to look at working on sustainable and sort of profitable projects as we go along. So that's really the focus. So we will see margins go up, but then margins going up, as you would appreciate, is a factor of several things.
Right. True.
You see which are playing out in front of us now. So we'll have to wait and see. But we're quite positive that the margins will be better than what it was in the past.
Two-part question, sir. And what are the kind of... So since you mentioned you'd be selective in your orders, in choosing the kind of orders you bid for. So what are you anticipating in terms of order inflow this year, since you have already won 2 ultra mega orders in this quarter itself? So what are the kind of order inflows you're anticipating, 1? And 2, since you mentioned about execution and there are a lot of other things that you need to work on to improve margins, what are the execution targets that you have set internally for you as a company? Because there have been a lot of these managements who have come to us and they've mentioned that execution has been delayed for various reasons whatsoever, be it manpower shortage and so on and so forth. So what are the execution targets here and the expected order inflow?
Yeah, so I'll take the execution sort of targets/challenges first, and then we'll talk about the order inflow. So, well, I mean, they're right. I think we face, in my opinion, we face 3 major challenges in execution, which are, and it applies to sort of everybody in the industry, really, which are a little bit out of our scope. One is the availability of front to do the work, you see. So the way the contracts are structured is that supply goes as per the schedule, but erection and stringing and commissioning happens really, that depends on the availability of the front. So to a large extent, even though ROW is not really within our scope, we are dependent a lot on our customers and our clients to provide the fronts on time, so that we can, go ahead and finish this work quickly. I think the second challenge that we're facing is availability of skilled manpower. See, what's happened is that a lot of work has come over a short window of time, and as a result of that, it's put a bit of pressure on a sort of limited pool of skilled manpower, particularly in the area of erection and stringing. And much needs to be done in that area, given the outlook for this sector is also quite positive going forward. And the third challenge is really around equipments, P&T, power transmission and distribution, equipments that are sort of to be made available, and those are challenges out there. Now, these are the major challenges, to be quite honest. And then it's around sort of working alongside with your clients with a sort of a spirit of partnership in order to sort of get this done. But then the focus is always on, at least our focus is always on execution. We want to get the job done on time and move out. Now, coming to the sort of other point on, was it order book? Could you repeat that question?
The estimated order inflow, Mr. Ganesh, what are you expecting this year?
Right, the estimated. I mean, it's a bit difficult to give an answer for that, to be honest, because as I said, our focus is going to be largely on the quality of the order book as opposed to the quantity. I mean, once we reach a certain amount of minimum efficient scale, which is needed in this business, and after that, it's really about, focusing more on sustainability, focusing more on profitability. So I wouldn't wager a number here, but our effort would be to pick projects more selectively.
I'll rephrase that question then. If you can't give us a number, have you bid for projects? If you have bid for, if you could give us a number, one word answer, number for the projects that you have bid for and the projects that you're currently L1 for.
Right. So bidding is a continuous process. You see, I mean, if you look at if you sort of look at a number, we'd probably be looking at bidding for upwards of 1,000 to 2,000 crores. But again, it all depends on the quality of the of the bids and sort of our ability to execute it and profitability. These two aspects.
Okay, Mr. Ganesh, thank you so much for joining with us on the show and explaining us the outlook for the company going forward. What are we watching out for in terms of order inflows as well as in terms of the margins of the company? But on that note, we're going to slip into a very short break. We'll get you more updates on the market on the other side.
If there was a unanimous decision to choose the color of the day, it was green. 315 points higher on the Nifty, almost 1,000 higher on the Sensex now. The broader market's continuing to rebound, almost 700 points higher on the mid-cap index. And we call time on this edition of Trading Hour. Vinny and I take your leave. Thank you so much for watching. Halftime report on the other side.